Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
You are listening to the Spend Life Well Show with Kingdom Advisor Mark Trice and Jesse Hamilton. Mark and Jesse are passionate about seeing you spend life well. If you want to save for and invest in the future, then this show is for you. Call now and join the conversation with your financial questions. 512-452-1120. 512-452-1120. Mark and Jesse will answer your questions and discuss practical financial principles based on a foundation of biblical wisdom. So if you're ready to quit worrying about your finances and begin to spend life well, then call 512-452-1120. And let's meet your host, Mark Trice and Jesse Hamilton.
Advisor Mark Trice, and I want to welcome you to our show where we apply biblical wisdom to your financial life. Now, this normally is a live call program, but you can call us anytime at 254-282-0495. That's 282-0495. That's area code 254. This week's Bible verse is Matthew 6:19 through 21, and this is one we have on our wall in our office. Do not store up treasures on earth where moths and vermin destroy, where thieves break in and steal. But store up for yourselves treasure in heaven where moths and vermin do not destroy, and where thieves do not break in and steal. For where your treasure is, there your heart will be also. I want to welcome you all. Jesse's off this week, and we wish him well. He's off doing some ministry work with his fellow musician friends at some summer camps for teenagers around Central Texas. So I hope he's having fun. And this has been a busy week for news, and I want to get into that. But first, let's kind of summarize what went on in the second quarter of this year. You may have seen the headlines that the first and second quarter, the first half of the year for the stock markets were the worst start. That's the worst start since 1970. Folks, I'm not a young man, but I wasn't even born then. And many of you who are listening to this show may not have been born then, or you were just young adults yourselves. That's when Nixon was in office, and things were going on in Vietnam. So needless to say, it's been a long time since we had a worse start to the year on the S&P 500, going all the way back to 1970. So the second quarter was really, quite the mix of economic data. In fact, we were talking around the office, and we were talking about what this kind of compared to, and it was almost reminded me, I'm going back to high school English here, folks, so please bear with me. It reminded me of Macbeth in the Act 4, Scene 1, with the witches that were sitting around the big pot going, double, double, toil and trouble, fire and burn, cauldron bubble. It certainly seemed like a witch's brew of things going on and converging on all parts of the market this last quarter. So often when things go awry, we're told to be patient. Since similar events have happened in the past, our brains tell us that this time it's different, until the issue passes and by us and it starts looking much like the past. However, as a financial advisor or a trained economist, I think this time is actually really different. In all the U.S. stock market history, bonds have always been an effective safety haven to reduce portfolio volatility until this year. Historically, when stocks fall, treasuries rise, or at least they remain flat, providing some protection until this year, when bonds have fallen nearly as much as the S&P 500. That's never happened before until this year. Historically, in times of market turmoil, whether inflation or crisis caused it, gold is expected to be a haven, a safe haven, until this year. Gold isn't acting according to script. It's down roughly 5% this year, and it's down around 15% from its early March peak. In normal bear markets for stocks, interest rates and inflation are falling, which is good for bond prices. Until this year. After flooding the economy with digitally printed money, the Fed watched inflation accelerate. We were told that inflation was transitory, not to worry. This week, we saw the inflation print come out at an annualized rate of 9.1%. That's higher than economists had predicted. Both Secretary Janet Yellen, that's Treasury Secretary Janet Yellen, and Fed Chairman Jerome Powell have apologized to Congress for making a mistake. However, folks, we are the ones that are paying the price. And inflation may not have peaked. As I said earlier, the Consumer Price Index rose again, about 1.3% in June. That was higher than economists said. That's an annualized rate of 9.1% year over year. And the delay in addressing inflation is in part causing wages to rise as employers try to retain staff. Now, wage cuts don't happen until a deep recession causes businesses to close. And also, the delay in addressing inflation, I'm talking about the Federal Reserve, the delay that they've had in addressing inflation is causing home prices, and more importantly, equivalent rental values to rise. Like wages, rents don't drop until vacancies are everywhere you look. And that isn't happening anywhere except in the middle of the deep blue states or cities. In prior bear markets, business was slowing and inflation was dropping. The Fed was able to lower interest rates so businesses and consumers would be confident to spend money, thereby stimulating the economy until this year. Inflation is forcing rates higher, whether by investors or by the Fed. And another way to look at the situation here is let Chairman Powell, this is Jerome Powell, chairman of the Federal Reserve. He's kind of like a trolley car switchman. You know, imagine there's there's a fork in the tracks, and there's two choices. He either has to pull the switch, and we have high inflation, or he cannot pull the switch, and we go down the same track, and we have recession. Two choices. Inflation or recession. Now, the rising rates, in other words, higher rising rates makes the dollar stronger, and that hurts profits of our large multinational companies. Lower profits are bad for stocks. Well, then maybe we'll choose the recession. Well, that's bad for stocks too. Businesses will shrink or close, and unemployment rises. Except this time is different. The Atlanta Fed, and I'm going to get into this a little bit more detail in a moment, the Atlanta Fed now data indicates we're already in a recession, except that prices aren't dropping. Shortages are still problematic. Employers are hiring, they're not firing. The stock market, this has been the typical pattern this year, is the stock market rallies for a week to 10 days and then unwinds the advance. Even the perennial optimists like Jamie Dimon from JP Morgan Chase, they've changed their tune lately. Last week, we started talking about all the different things that the media will throw at us. It's like the perfect storm or a black swan event. All things that are references to the weather and things like that, and calamities that just don't happen that often. Last week, Jamie Dimon changed his tune and started warning of a coming hurricane. Even though a lot of economists say that we're not currently in a recession, the Atlanta Fed's GDP now has been lowering its expectations for economic growth in the second quarter almost by the day. In fact, I just realized that I was looking at my show notes. I haven't updated it this week, and I know it's down even further. So back at the end of May, the expectation from the Fed for economic growth, and we measure that in the form of GDP or gross domestic product, was a little north of 2% on an annualized basis. That's pretty good considering the situation that we're in. Last quarter, it was a negative 1.6%. But since then, since the end of May, we've seen the Fed continually lower that estimate. And last week, we had an estimate of as low as minus 2%. Now, that Fed growth rate for the GDP will come out later this week, I think, or next week, I think it is. And we'll know for sure. But I would expect to see a lot of changing of the definition of an inflation because the textbook definition of inflation is 2 consecutive quarters of negative GDP. Now, why do I share all this? Because you might think this is not the Spend Life Well show. This is the gloom and doom show. It's not to alarm anyone. It's not to get you to worry because the Bible tells us that we are not to worry, that we are to put our trust in God and through prayer, we ask for the things that we need. It's not to do that. It's just to get you to pay attention because I get the feeling from a lot of people that they're just not paying attention. And we're going back to that bad behavior of just simply burying our head in the sand like an ostrich. If I don't look at it, then it's not really happening, right? And so we're going to see, because of that inflation print that we got of 9.1%, which was much higher than economists expected, we're pretty much going to guarantee that next week the Federal Reserve is going to go ahead and raise interest rates another 0.75%. And I'm guessing that they were going to be a little bit more aggressive this time. And so you're going to continue to see the volatility in the markets. You're going to continue to see interest rates rise. And what we're not seeing is we're not seeing that translate to savings accounts. And so people are really concerned about what's going on with the markets. You can send us your questions anytime. You can give us a call at 254-282-0495, 254-282-0495. We'll try to answer those questions on the show, but a financial advisor will be available to you to answer those questions, and we can kind of help you get focused on what it is that you need to talk about and to get that answer for you. So I think it's really important for people to really start taking ownership, looking at what's going on and in the economy. And so I was talking just a minute ago about all the different language that's being used regarding inflation, from the black swans to hurricanes to the perfect storm. And I think what people are trying to do is just simply try to get a visual image to explain why they don't really know what's happening. And I say that in a serious tone because we can turn on the television and I can listen to the pundits talk about what they think's going on. And the reality is, based on what I just told you in the opening segment here, that the experts really don't know what's happening. But you can take control of your investments, your portfolio, by simply having a game plan for what you're going to do when the markets are going down. When we come back into our next segment, we'll give you a market update, what's been going on the last week or so. We'll also take some questions from our listeners and answer those. But you can send us an email too at radio@spendlifewell.com. That's radio@spendlifewell.com. And we'll get those questions answered. I'm excited about the second half of the year. I think there's going to be a lot of positive change that goes on in our economy and in our government and so forth. There seemingly is not a lot of positive things that seem they're out there right now, but I'm confident that one thing is true: the Lord will provide, and this too shall pass. And I'm excited to what's going to happen. Now, if you're concerned, you should talk to a financial advisor. If you don't have one, you can call us, and we'll be happy to visit with you. We have offices all around Central Texas. You can give us a call at 254-282-0495. 888-282-0495. We do want to talk to you. This program was created so that we can make sense of the world around us from a biblical perspective and really trying to help folks see their finances from a Christian worldview. And so we love to get into and talk about what Scripture says about our wealth and possessions. We believe here that we are called by God to be good stewards of the resources that we've been entrusted to, and we want to try to prepare and equip you, our listeners, to do just that. So, I don't want to, like I said earlier, I don't want to be seen as Mr. Gloom and Doom, but I think it's important that we pay attention to the things that are in front of us and try to make sense of that. And this is not the time to bury our head in the sand, a proverbial sand there, if you will, and hide behind those things. So, when we get back, we'll talk a little bit more about the news. We will go over the market performance for the year. And then later in our show, we will talk about how do you get started with investing? Because a lot of people they're on track, they want to start saving, and they're concerned about the economy. What's the first thing that we need to do to get on track for saving for a future goal? And this is important. I think that we can go back to the parable of the talents. You got the three examples of the stewards that were there. One decided that they were just going to basically bury their money in the sand, and that's not the right thing to do. We need to be working on our investments at all times. We're working and building our savings because I think that's what the Scripture tells us to do. And we don't want to put our faith and trust in money, but we need to make sure that as stewards, we are working to increase and improve so that we can bless others and also prepare for our future as well. So, like I said when we started the program today, a lot of mixed news out there. Some of it positive, some of it not, and we're here to talk about those things. I'm Certified Kingdom Advisor Mark Trice. You're listening to the Spend Life Well Show. We will be back in just a moment, but if you want to give us a call, 254-282-0495. We'll be right back. All right. Welcome back to the Spend Life Well Show. I'm Certified Kingdom Advisor Mark Trice. We thank you for joining us today. If you want to talk to us, a financial advisor is ready to take your call at 254-282-0495. That's 254-282-0495. We've been talking about the economy and whether or not we're in a recession. It doesn't really matter if we're in a recession or not, because the consumer confidence report that came out last week is basically saying that, hey, we're acting like we're in a recession. So it doesn't matter if we are or not. We've seen that people are slowing down their purchases, right? And so if we have a negative view of the future, we're less likely to buy something that we may have been planning on buying. We may want to wait to see that. Maybe we're concerned about our job. I think one of the things that's really different about this economy this year is that we're still seeing employment really pick up, and then people are still looking for jobs. There's a lot of job openings, and we're seeing unemployment stay pretty level. Now, what we have done or have seen is we're not seeing wages keep up with inflation. And with the print today of the CPI, the Consumer Price Index, year-over-year inflation rose to 9.1%. We haven't seen this since 1981, and many of you remember what it was like in 1981. And so we're not seeing wages, even though we're having small increases in wages, we're not seeing that keep the pace to stay ahead of inflation. So what's happening? Well, Americans are tapping into their pandemic savings to help cope with inflation, or they're starting to borrow more, putting more money on credit cards, which is not good things to be doing when we think there's a recession around the corner. So at almost all income levels in the first quarter, we saw households draw down those savings to cover costs. And it's about 114 billion was spent down on savings, according to Moody's. Okay, Moody's Analytics does a lot of analysis of government data, and so now during the pandemic to the end of 2021, Americans built up over $2.7 trillion of extra savings, according to the Moody Analytics. And the COVID-19 lockdowns kept people at home with nowhere to spend money, except for maybe Amazon or something like that. And many households received 3 rounds of stimulus payments, and that boosted their incomes. Now, with inflation at its highest point in decades, and wage gains, as I said, are starting to trail behind, people are starting to turn to those savings or turn to basically using credit cards again. So like I said, there's a lot of mixed data. Let's look and see how the market has done over the last week. The S&P is down over 20%, okay, from its peak. And that is officially a bear market. We've seen the NASDAQ down over 27%. It's for the year to date. And that's up over 30% since its peak back in November of last year. Something similar with small caps, down over 22% year to date, down over about 24% since its peak back in December. Now, the interesting thing, I talked about bonds earlier, right? Talked about bonds. Well, the interesting thing is that bonds, normally a safe haven, are down over 20% year to date. That's not normal. And we're seeing maybe a little bit of relief in the 10-year treasuries and things, but what we're seeing is the yield curve is flattening out, meaning that short-term rates are starting to rise in anticipation of rising interest rates, and the long-term rates are staying flat or they're falling. And so you have a yield curve, which is not healthy. When you have a yield curve that's flat like that, that's a sign typically at a recession is somewhere around the corner. Now, I don't have a crystal ball. I don't know when that's going to happen. It may not happen at all. Hindsight is always 2020 when you're looking behind us, right? So we don't know what the future holds either. And so don't worry about that. But there's certain things you might want to be doing, like slowing down your spending, making sure that you have an emergency fund, and prepared for any types of changes and stuff. Okay, we're already seeing that now in that it costs a lot more just to buy stuff, right? Buy groceries, buy gas. So all those things are impacting us. So bonds, typically a safe haven, have not been a safe place to be this year. We are seeing the 10-year Treasury fell a little bit over the last week, just barely, and we're starting to see 30-year mortgage rates drop just a little bit, but that's been very volatile, up and down, up and down. So I want to go to some questions from our listeners. This question's from Rick and Kyle, 2 first names, Rick from Kyle. He says, "I spent the last few months building my wife and I a budget. I can't seem to get an accurate total because each month is different. One month expenses might be $2,000 or more than it was the month before. Is there a good way to plan for those differences?" This is actually a pretty common question we get, Rick, and you're not unlike a lot of other folks as well. And so a lot of times we have to build a budget or a spending plan. Budgets are so boring. I don't like to do a budget. It sounds depressing whenever you talk about a budget, right? We'd prefer to talk about spending plans. But, when you're building a spending plan and you have a lot of variable expenses, what's a example of a variable expense? Well, it might be our auto insurance. Well, I just pay that once every 6 months, right? Or my homeowner's insurance. I might pay that once a year. And so if you don't have money in your monthly mortgage payment. So you want to act as if you are paying, if it's the homeowner's insurance, it's once a year, let's just say it's $1,200 a year. I want a budget for $100 a month, right? Because $100 times 12 is $1,200. That's my homeowner's insurance that I have to pay once a year. So I want to act like I'm spending that $100 every month. I just sit it in reserves, sit it in a little savings account that I can't touch because it's for a future expense. So once you normalize those annual and irregular expenses and set them aside, that budget won't be a problem, right? Because you will always have the money there to do this. And, my wife and I, when we were starting out, we had the same problem. It's like we could never get ahead. And it was because, Rick, we weren't thinking ahead. It's just like people that go into debt for the Christmas holidays. Christmas happens every year, usually around the same time. In fact, exactly the same time, December 25th. We know when it happens. Birthdays for your kids or grandkids, you know when they happen. We just don't plan for them. And so if we're going to spend a amount of money in the future, I've got to make sure that my budget or my spending plan is reflecting that future expense. So set aside a little bit now for that future expense. There used to be years ago in the banking industry, usually with credit unions or local banks, the Christmas Saver Plan, right? Christmas Saver Plan. It was just basically a way for you to get you to save starting in January for Christmas expenses in December. But that's kind of what we're doing with these irregular expenses. We're setting aside that special savings account, just a normal savings account, and we're setting aside, 1/12 if it's an annual expense, or if it's every 6 months, we want to be doing that every month. So you simply divide those expenses by that amount. So, Rick, a great question, and a lot of times it's hard to think through those things, but you're really just saying, what future expenses will I have or I anticipate that I know of, and start setting aside money for that in the future. Okay. Another question from Ben and Leander. Ben says, "I understand that crypto is not a reliable investment, but I still would like to be involved with a small amount of my savings. Would it be a good time to buy the dip because it's so low right now?" Crypto's been having lots of problems, Ben, and I think we saw Bitcoin. I haven't seen what Bitcoin's doing today, but Bitcoin has gone from its stratospheric highs in the $60,000 or so down to below $20,000, and it is very irregular. Now, what a lot of people began to, this is before our current economic situation, but a lot of people began to say, "Hey, crypto is just a hedge against a falling market." But what we really found was that crypto was kind of tracking what was going on with the tech industry and the tech markets and the tech indexes, like the NASDAQ. And so, you have to be very careful. If you want to invest in something like cryptocurrencies, you need to understand that they are not regulated, that they are susceptible to be stolen, right? There's been plenty of articles in the news media lately about people stealing people's passwords and basically taking their crypto or their coins hostage. And so you have to be very careful with that. If you feel like should be part of your investment portfolio, that's fine. Do it in moderation, though. You certainly would be better to buy when it's lower now and it's pulled back quite a bit. But I don't know that that's the bottom. There's some analysts that say that Bitcoin could go to $3,000. Okay, and that's quite a bit ways down from where we are. Excuse me, the pun. But there's lots of reasons why you might think about that. Okay, just understand where you're investing. A number of the platforms have gone under, and so you want to make sure you're with a reliable platform to purchase that crypto technology. I got another question here from Michael. Michael in Austin. What is the minimum amount of money it would take for me to start investing for my retirement? That's a great question, Michael. And I think it's a good question for us to transition into starting and talking about what do you need to do to invest. Now, there are a number of different options out there that are suited for folks that are just beginning to invest. Now, one of the things that we really talk about and try to stress with all of our clients and our listeners too is that you really want to first start with your workplace retirement plan. This is after you have set aside an emergency fund. Dave Ramsey talks on his program and stuff like that about starting with $1,000 if you are trying to get out of debt. But assuming that you've got out of debt, you probably want to have 3 to 6 months of living expenses setting aside in just cash, liquid cash, something that's not invested, so that if you have an emergency, you can cover that first. Now, before you do anything there, Michael, I think it's important that you master that. And that's not very exciting to be saving up cash because a lot of times people call us up and they want to start investing because they want to get rich quick. Well, that doesn't happen, and we try to steer them away from investing because they're going to lose money probably because they're throwing caution to the wind and not considering all the risks that are out there with investing. So you want to think about these things, okay? But once you've done that, we think one of the best places for you to start investing is through your payroll deduction at work in the 401k plan, or maybe they have a SEP or simple IRA out there for you to invest in. If you're a government employee, there might be a 457 plan for you to look at. But it's important that you take advantage of that first, because that oftentimes is a method that you can get your money, your contribution, your saving matched by your employer. And so I think it's important that you start there with that. But so let's recap this just a little bit before we wrap up this particular segment. You need to have that emergency fund, 3 to 6 months of living expenses. If you have much more than that, and you don't have a particular financial goal for that cash, you really are, forgive me here, you really are kind of hoarding. Okay. You're hoarding cash, and you're not, in my mind, being a good steward. What the Bible says about that, you're basically hanging on to cash for various reasons. And we see people all the time. We see people all the time that they're holding on to cash because their self-worth, their identity is in their bank account balance. And folks, I don't want you to be that way. That's living in fear. But we've seen too many times where, someone that would come to us to talk to us would be really, you could see that, their whole self-worth, their positive feelings about themselves, their negative feelings about them was reflected in their bank account balance. And that's just not healthy. But if you're excuse me, I didn't mean to say hoarding again. If you're hanging on to a lot of cash and it is well beyond, let's just say 12 months of living expenses, then that's a lot. That's a lot. Should you be investing? Well, and when we come back from this break here, we're going to get into that a little bit more to see if you should be investing. And Michael will answer your question as well as to what's the minimum that you can start with. It's very, very, very nominal. There's a number of different places where you can start with just a few dollars. And that's the thing, Michael, is starting. A lot of people are overwhelmed by all the different types of investments and things, and they don't want to lose that money that they've set aside. They want to do something, and they just don't take action. And so I encourage you, Michael, the first thing is make sure you got a good emergency fund. Do something, get started with a workplace plan. And when we come back in just a few moments, we're going to get into the different things you need to consider there. Folks, thanks for listening. We'll be right back. I'm Certified Kingdom Advisor Mark Trice. You've been listening to the Spend Life Well Show. We'll talk to you in a few minutes. Welcome back. You're listening to the Spend Life Well Show, where we apply biblical wisdom to your financial journey. I'm Certified Kingdom Advisor Mark Trice. I'm thankful that you decided to listen to our program today and participate. So if you've got questions, you can send us an email at spendlifewell.com. That's radio@spendlifewell.com. You can call or text us. I should have said that earlier. I forgot. You can text us at this number, or you can call us at this number. A financial advisor will respond to your question. That's 254-282-0495. 254-282-0495. Send us that question. We've been talking today about saving and investing. We're talking about the markets and the economy, what's been going on there. And I just want to bring us back to our verse for the day, which is Matthew 6:19 through 21. This is one of my favorite verses because it really is the verse that I want to convey to people as to how our attitude towards money should be. It's not about the balance in the account. It's not about how much money you made with that stock or investment. It's about the condition of our heart. And Matthew 6:19 through 21 says, "Do not store up for yourselves treasure on earth, where moths and vermin destroy, and where thieves break in and steal. But store up for yourselves treasures in heaven, where moths and vermin do not destroy, and where thieves do not break in and steal. For where your treasure is, there your heart will be also." So it's really about what's the attitude of our heart. Why are we wanting to invest? Why are we wanting to save? Do we have a specific goal? Have we prayed about that particular goal or need? And are we taking action to be good stewards of that money? If we're trying to store up treasures here on earth just for the sake of accumulating, I think we're violating the intent of that verse in Matthew. And we have that verse on our wall in every one of our offices. And it's so important to us that we talk about that with our clients, because we want to make sure that you have a healthy view about money and not that negative view that I talked about in the last segment, and have the right approach to managing wealth. Because I tell you, folks, if we believe that God owns it all, and we are here to be good stewards of the gifts that He's blessed us with, then that has a whole different effect on me. And I'm sure it does you too. Has a whole different effect on me. I think twice about the things that I spend money on. And I like to spend money. I really do. When I have it. I like to spend money when I have it. And I like to enjoy life. I like to do certain things, but I want to make sure I got the right attitude about that. And so if there's something that you've been struggling with, perhaps it's something that you are spending money on and you wish you didn't, just pray, ask the Lord what it is that you should be spending your money on, and that will help guide you a lot. I found that oftentimes if I don't know what to do, or if I'm struggling with something, and maybe I'm spending money on something that I don't think is completely honoring the Lord, I want to correct that, and I'll just pray. You call into the show, we'll pray with you and help you along that way. So anyway, that verse is so important to us. It's so important to the folks that we meet with, because we want to make sure that we're all on the same page, that we believe we understand who owns it all, how we got the wealth that we've been entrusted with, and what we need to do with it. So before investing, you want to, as we talked about, want to have that emergency fund. You should really consider, your 401k or employer retirement plan. But beyond that, you want to consider your goals and time horizon. And there's a lot of terms here I might throw out that might be confusing, but we talk about risk tolerance, diversification. You want to understand, what is the time frame that I have to invest. I've gotten some calls recently from folks. Maybe they sold a house and they're going to build a new house, or whatever it may be, or they got a short-term goal. And they're asking me, "Okay, Mark, what can I do with this money that I've got sitting here burning a hole in my pocket?" And if you have a short-term purpose for that goal, I don't think you want to do anything with it. I think you want to look for a money market fund or a savings account that's paying the highest yield that you can find. And if you want to call us, we can give you some suggestions, or you can go to a website like bankrate.com. Bankrate.com has a list of all the national and regional banks and the rates they're paying. It's a great place to go and search for things so that you can kind of see where can you get the best return on your money if it's short term. Because if we have a goal, let's just say that your goal to buy that new house is a year from now. Well, that's a very short time horizon. And I would not advise you to be investing in anything that might involve risk. Now, risk is the possibility, the potential that you can lose your money. If you don't have a longer term investment horizon, time horizon, then your risk is actually increased in the short run. So if I have a goal for a year from now, I need $100,000 or $200,000 for the down payment on that house. I don't want to risk that, because if you have a situation like we're having the first half of this year, your $200,000 is now worth $140,000 because you've lost 20%. Okay. So time horizon is very important. And then I mentioned something about risk tolerance. Well, the best way I know how to explain this, folks, is think of your favorite type of roller coaster at Six Flags. All right. And I haven't been to Six Flags in forever. And when I probably was a teenager at the time. At the time, they had the Texas Giant, which is a big roller coaster. They had the Cliffhanger, and then there were simpler rides like the Runaway Mine Train, or there you could even float on a little inner tube or whatever, a little boat called the Lazy River. So, are you the type investor that enjoys the Cliffhanger, or do you prefer the Lazy River? So, are you a very conservative investor, or are you more of a big risk taker, aggressive investor? And that's really important to understand. If you don't know how to do that, you can go to our website at spendlifewell.com, and we can direct you to some tools that we have where you can understand what your risk tolerance is. I think it's a great tool because a lot of people think they're more risk tolerant. In other words, they prefer more aggressive investments until the volatility happens, and what they thought they could handle, well, they really can't tolerate. And so we see a lot of people right now that are very uncomfortable with the market volatility. And before, whenever they were first investing, they thought they could handle the Texas Giant or the Cliffhanger. Not so much anymore. So you need to understand your time horizon, your risk tolerance, and we can talk about diversification as well. But I think it's important that you look at the different types of investments that are out there, or investment platforms, excuse me, that are well suited for beginning investors. And that's the 401k is the first one. You might choose a robo-advisor out there. There's a number of folks out there. We even have a robo-advisor option, but there's lots of different types of target date mutual funds and index funds. And in the last 2 years, there's been a whole host of investment apps. But generally, stocks and bonds are the two main asset classes, and you really don't need much of anything else. Now, I just completely oversimplified investing, but that's generally what most investors are looking at: stocks and bonds. And they typically are going to be, you can find mutual funds or exchange traded funds out there, and a lot of them are just going to simply track an index. All right, they're going to track the market. Maybe they track the S&P 500. Those generally are a cheap way to buy stocks and bonds, is through mutual funds and exchange traded funds. And that what do I mean by cheap? Well, you generally are going to pay lower fees than in what's in an actively managed fund. Okay, now we run actively managed portfolios, and that's for a different show. Now, how do you diversify? This is the whole conversation. Do you buy the whole market, and you minimize the effect, or do you concentrate your investments in one particular area? We think that you should spread your money around. In fact, that's what Scripture says. In Ecclesiastes, Solomon talks about sending and spreading his money around in many different areas, and we believe the same thing should happen too. You can try to put some money in crypto, but I've seen so many people lose their money in doing that. Be careful of these meme stocks as well. This is a big hot thing during the pandemic. And most of those meme investors that jumped on the bandwagon there still haven't got their money back. And we talked about having a short-term savings bank account or money market, because you want that to be secure. You just want to be careful about that. There's a lot of talk out there about I-bonds, which are issued by the Treasury Department, and they're paying, I think at the last check, the inflation rate is 9.62. I'm sure in September, when they adjust the rate, that might go up a little bit more. But a lot of people are asking about those things. You can only buy that through treasurydirect.gov, and you're limited to $10,000 a year that you can put into those things. But those rates will vary, and when inflation comes down, so will your yield that you're earning on those things. Okay, because there are two parts to the I bonds, treasury bonds that are out there. There's the fixed rate, which currently is 0, and there's the inflation rate, which is currently 9.62%. Okay. Um, the inflation adjusted rate varies, and it can go down. It can actually be negative. So there is a possibility that the rate that you're earning, the yield that you're earning on an I bond, can be negative. So, but I would stay away from all those things necessarily. I would just start with the emergency fund. Look at your 401k. If you want to go beyond that, you might be able to invest in a Roth or traditional IRA. Those are accounts that we can help you set up. And you just want to focus on the simple stuff. Buy the indexes. Do the passive investing. Don't try to time the markets. No one can. Now, if I had the luxury of youth, I'm not old yet, but I'm not young anymore either. With decades ahead to recoup any possible losses, I would take more risk. That's me. And that's me, and that's me knowing a lot about market history and things. In fact, despite the pain of the bear market, understanding what I know now, I would probably invest a lot in stocks if I were in my teens or 20s. You also, folks, you need to understand the risk that you're taking. Don't buy stocks unless you're prepared to endure the paper losses. And now, what are paper losses? Well, this is when you own a particular stock and you buy it for $100 a share and it goes to $50 a share. Well, on paper, you have lost value in that particular security or stock, right? Okay. But we invest for the long haul. Now, unless there's something fundamentally wrong with that particular company, you probably don't want to sell that stock anytime soon. I remember back in the early 2000s, several of my friends were buying the hot tech startups. And thank goodness, because of where I was working at the time, I could not buy in the late 90s, early 2000s. I couldn't buy a lot of those tech companies because my employer was the auditor or tax preparer for that particular public company, and we weren't allowed to do that. And as a result, when the tech bubble burst, I wasn't holding a lot of tech stocks, so I didn't lose a lot of money in that situation, even though markets went down a little bit. But you have to understand the risks that are associated with that. Just because your stock that you bought is down 50% doesn't necessarily mean that it's time to sell. But you do want to talk with a financial advisor. I encourage everyone to have a financial advisor. There are so many people out there that are willing to help you get started and get started with investing. We certainly are. We've got advisors that are actually standing by in the last few minutes of the show, 254-282-0495. You can call that anytime during the week. Just don't call during church on Sunday. I will not answer the phone, and neither will any of our advisors because we're worshiping with our families, and we want to protect our privacy there on Sundays at least. So, but I would encourage you, if you haven't started investing, now's the time to get started. Make sure you've got that emergency fund. Make sure you've got the money set aside for those emergencies. Make sure you've got a good spending plan, and start with the basics. Start with your workplace 401k plan. They usually don't have many choices. They got some mutual funds, some stock mutual funds, some bond mutual funds, or if you don't want to pick, you can choose a target date retirement fund that you can put in there that basically you tell them the age at which you might retire, and they will set up an asset allocation for you that's a mix of stocks and bonds that gradually gets more, I'm putting my air quotes up here for the people that are watching, gets more conservative over time, except that hasn't worked really well this year. Doesn't mean that it won't work well in the future. So just make sure that you don't put yourself in a spot where short-term declines in the market or in the fortunes of an individual stock that you own hurt you. You want to set you up with a good, solid foundation. That emergency fund is so important. So as we're thinking about the coming week, I want us to remind ourselves of that verse in Matthew 6, where we're talking about storing up treasures in heaven. Because, folks, most importantly, it doesn't matter what our bank account balances are. What matters most is if we have a relationship with our Lord and Savior, Jesus Christ. And I want to encourage you to get involved in a church somewhere, join up, and I think you'll see the Lord bless you in many, many ways. And we're here to help with your finances, folks. Give us a call anytime. You've been listening to the Spend Life Well Show, and the Lord willing, we will be back next week. I'm your host, Certified Kingdom Advisor Mark Trice. Thanks for listening to